Okay, so let's kickstart the session, right? So for just a quick introduction of myself, I'm Lee Sing, right? So if you guys are watching a recording of this and if you have any questions, please feel free to reach out to me on LinkedIn. So just a quick disclaimer, right? The information presented here, it's not to be treated as investment advice. It's for educational purposes only. So this is the agenda that we will be covering for today, right? So first we will hop on to understand a bit more on stochastics as an indicator and also how we can combine them with market structures. And moving forward, right, we will also be using moving average, right? So how we can actually combine stochastics, market structures, as well as moving average to filter out false signals. We will also take a look at how we can use Fibonacci retracements to set potential profit targets. So this will be coming together, combining the different series that we had over the past few months. So trying to piece them all together with our strategy. Okay, and then finally, we will cover on risk management. So as always, right, try not to risk anything beyond 2% in each setup. So we need to ensure that we are practicing proper risk management and also so that we are able to sustain this in the long run. Okay, so just a quick recap on stochastics oscillator for the benefit of those who are not familiar with it. So basically, stochastics oscillator by itself, right, it's a momentum indicator. So it compares its price range over X amount of period, right? So this is usually by default 14, but it's determined by the user. Stochastics also consists of two lines, right? So if you load the indicator on TradingView, you can see that there will be a fast stochastics line as well as a slow stochastics line. So later on, we will hop onto the chart to take a look at that in details. But the idea is that if the fast stochastic line crosses above the slow stochastic line, right, that's interpreted as a bullish signal and vice versa. Stochastics itself has two bands as well, right? So this is the range. Generally, right, it can be either 80-20. So this again can be determined by the user, right? So 80-20, it's the general setting, or you can adjust it slightly so that it's more sensitive, right? So some people use it as 70-30. So which means that when price crosses below this range, right? So when price crosses below the 20 range, then this is seen as oversold. So what this means is that we expect price to bounce or to reverse, right? So that's the general concept behind this. And if price enters into this overbought range here, right, we're expecting the buying pressure to wind down. So we could be seeing a slowdown in momentum, especially if this is combined with divergence. So one thing to note is that when you compare this to range, right, so comparing 80 and 20 as compared to 30 and 70, you can see that when you have a much narrower range, right, there's a higher chance that stochastics will exit this region, right? So there's a higher chance that it will go below 30 as well as above 70 as compared to if you are using 20 and 80 as the measurement. So in this case, right, the narrower the range, right, the more signals you get, but this can also in turn lead to more noise, right? So there'll be more false signals, especially with every exit. So two things to note for stochastics is that generally I like to use it with the exit of the region. The reason behind this is because you can see that if prices are trending, right, so stochastics usually work in ranging market, right? So if prices are testing a support resistance area, then you can see that at every exit of stochastics, right, then it'll match with the reversal points. But if prices are in a strong bullish market, for example, you load stochastics, you can see that stochastics generally stays in the overbought region for a prolonged period of time, right? So even when it exits the overbought region, usually this exit itself is characterized by a pullback in the market before it continues to the upside. So that's one, right? So first it's using the region or using this band and using the exit of this band as confirmation. And the second one, which actually this is more important, right? So the second one, it's looking at market structures. So I've emphasized it again and again, right, in all the previous sessions as well, right? We don't want to just use the indicator blindly. We want to ensure that the way we're using the indicator makes sense, right, with what is intended as intention, right? So what this indicator does well in, right, for stochastics is that it does well in ranging markets. So we want to ensure that at any point in time, right, if we're looking for entries, it's in line with our higher time frame structure. So if prices are in a bullish, showing bullish order flow, right, higher lows, higher highs being formed, pull back into this zone itself, right, and price starts ranging over here. Once price exit, right, so once stochastics exit the oversold region, right, then what this suggests is that there's a reversal, right, and there's an end to this pullback, and we could be seeing much higher prices. And this is in line with the higher time frame because prices are in a bullish market structure, right? So this makes sense. But if you're trying to trade stochastics in the downtrend, right, and trying to find that reversal, then in this case, right, it's best that we wait for a clear sign of change in the market structure, because what happens is that any exit of the region in a downtrend, right, exit of the oversold region here, could just be represented by just a slight pullback before it continues to the downside. Okay, so apart from just trading, in stochastics in isolation, we want to ensure that we are combining all these concepts together so that stochastic can give us a higher probability setup. Okay, so let's take a look at stochastics and market structure, right? So if we take a look at just purely market structures, you can see that for market structures itself, right, when prices starts forming higher low and higher high, you can see that this itself, right, these lows are not violated. So what I mean by this is that if you see that there are signs, right, that the highs are constantly being run, or when price breaks above this area, right, then what this shows is that prices could start trending to the upside. And when that happens, right, we're looking for pullback in price, right, to play the move up. So this uptrend, right, is actually characterized by successive higher lows and higher highs. And the first sign of that comes in when price breaks above this high, right? You can see that price starts forming higher lows, higher highs. If you want a more conservative signal, right, and then it will be this high, right? So looking at a break above this high, you can see that price broke above it, pulled back, and then following which you can see once again, right, consolidation. And this consolidation over here, okay, so this is probably not the best example, but ideally we want to try and find a zone where price comes into, right, support zone where price comes into, and this is also in line with stochastic exiting this oversold region. Okay, so this is not the best area, but you can see again, right, if I were to extend it across this region here, right, so there is a resistance and support level. So price reacted below this area here. There's more rejection before it broke above. We tested this region as a support. So we have a graphical area that's in place, right? So this level, it's also in line with the previous resistance. And you can see that stochastics, it's also showing bullish signal, right, with the exit of the oversold region. Not only that, right, so previously I mentioned that on stochastics, you have two lines. One is the fast line, represented the fast stochastics, right? So this is represented in blue. The slow stochastics, also used as the signal line, this it's in orange or yellow, right? So the idea is that if the fast line, the blue line, crosses above the orange line, then this is a bullish sign. Okay, so of course we don't want, again, right, we don't want to use this in isolation. We want to make sure that whatever we're using, right, it's in line with the overall structure of the market, right? So if prices are forming a downtrend, then in this case, right, having this signal where price exits the oversold region, right, this might not be as effective unless there is a change in structure of the market. And then price continues higher, then this, in this case, right, then this would make sense with stochastics. So I hope that this is clear, right? So in the next slide, we'll be taking a look at again, right? So previously we saw an uptrend. Right now, right, this is a downtrend. You can see this is characterized by successive lower lows and lower highs. So if you take a look at this move, you can see that stochastics, price, right, starts forming consecutive lower lows, lower highs here, right? So in this kind of scenario, right, you can see that every pullback itself, this pullback, if to match it to stochastics, you can see that the start of the move here, it's also actually corresponds to stochastics exiting this oversold region. But notice at this area, right, what happens is that in the downtrend, right, so we're expecting price to trend lower, which means that any pullback into resistance area, right, this itself can serve as good entry. So in the downtrend, right, you should be focusing on stochastics in the overbought region. The idea behind this is that if price exits the higher chance that this could be in the direction of the trend, right, for that move down, which is in line with the higher time frames trend. So you can see that even though stochastics did exit this oversold region here, right? And then this is also characterized by this slight pullback before it continues to the downside, right? This area. But let's pick another region, right? So here again, right, in a downtrend, you can see that stochastics once again exited this oversold region. The blue line is also above the orange line, right, which means that this is a bullish signal. But if we are taking it blindly just based on stochastics, you can see that without considering market structure, taking just the signal alone, right, you're playing just a slight move up before price continues to the downside. So in terms of measuring our risk to reward ratio, you can see that for one, right, we are trying to catch the bottom of the market. That's one. The second thing is that prices are not showing a sign of reversal, right? So if you want to use stochastics, especially in swing trading, right? So this is holding positions out for a longer period of time, right? Trading against the trend would not be in our favor. One other thing to note with this is that you can see for stochastics. So when price comes into this region, you can see that prices are very effective in reacting to these zones, right? So in a downtrend, right, with every exit of the overbought region, you can see that this corresponds to a huge movement downwards here, right? Because prices are in a downtrend. So every time price exits this region, let me just clear the drawings. You can see that with every exit of the overbought region here, right, it's characterized by a strong trend to the downside, right? Price probably broke some support level, continued to the downside. Once again over here, when price exits this overbought region, you can see that it again corresponds to the move to the downside here as well. And where we see a move here, and this is also characterized by a sweep, right? So price swept above the previous high, continue moving lower, right? I would really consider this an exit, especially because we're using the 80-20 band, right? So if you want more signals, you can see that in this case, right, it'll probably be better if we want more, more signals. Then in this case, right, we might want to consider narrowing the range, right? So making it to the 70 and 30th band instead. If that's the case, you'll get more signals. Okay, but of course, I've mentioned it again and again, right? It's important that we need to take into consideration the market structure, the overall direction of the trend, instead of just taking it purely based on stochastics. Again, the reason for that is because you can see that in a downtrend, right, any exit of this oversold region over here, right, this only corresponds to the slight pullback in price before price continues to the downside. So it's not in our favor to hold these positions, right? Because for one, we would know where exactly is the bottom of the market. Second thing is that we also wouldn't know where to put our stop losses, right? So this would probably be an arbitrary number, not based on market structure. Whereas if you're holding to on the downside, right, you can see that if price comes into this zone, okay, so in this case, let me focus on this region, right? So we see that stochastics came into this region, it exited the overbought region, right? In this example, you also have a resistance area here. So you want to consider putting this your entry at the resistance and then stop loss slightly above the zone, right? So even in an event that we are whipped up in this case, right? So this might or might not have hit our stop loss, but the idea makes sense because if prices are in a downtrend, right, we're not expecting a break above the last high. So if price breaks and close above this region, right, characterized by a strong bullish candle, this is when we're wrong on the position and we want to get out of the trade. Okay, so this is on stochastics, right? I hope that this is clear in terms of how we can combine stochastics with market structure. So let's hop onto the chart, right? I want to show you guys a few examples. So let me just bring out the chart. And at the same time, right, if you guys have any questions on stochastics, right, please do put them under the questions tab. Okay, so let's just take a look at, for example, gold here. Right, so before we move on to talk about moving average, right, let's talk about gold. Right, so let me just bring up this chart. Okay. Okay, so let me just load stochastics. Okay, so for those of you guys who attend the live session, right, you will know that usually I start the analysis on the higher time frame, right? So in general, the daily, the weekly would give us a general sense of where prices are heading or whether it's in a bullish or bearish market structure. So in this example, you can see that right now on gold, right, if I'm to focus on the most recent price developments, which is basically here, right? So anywhere from the start of this year, you can see that prices are on the daily, right? It's still forming your higher lows and higher highs. Currently, it's consolidating around this zone. And on stochastics, you can see that there is an exit of the overbought region, right? So this is a sign that the upwards momentum might be slowing. But if you look at it just purely based on daily structure, right, you can see that if I were to zoom out slightly, right, you can see prices are reacting to this supply region here, just on the daily, right? You can see that price came into the supply region. There was also the previous resistance area where we saw that sharp reversal, right? So price came in, pushed higher before we saw that rejection. And this area, right, we also saw a wick, or rather price coming in to mitigate this previous candles. So you can see here, right, there is strong buying and selling pressure, right? Price moving up, pushing up very strongly, and then coming into this region, there's also a strong rejection. So when price hovered and consolidated here, you can see that once again and tapped into the supply and then trended much lower. So when that happens, right, it then creates a new supply region where we saw price coming into this area, and right now it's consolidating here. Okay, so this is the picture on the daily. If we go on to the 4 hours time frame, right? So maybe I just take a step back, right? Before talking about the 4 hours time frame, you can see that what we are seeing here on the daily, it's that prices exited or prices are consolidating within this resistance area. There's an exit of stochastics. But on the daily time frame, right? If we were to go down from the daily to the 4 hours, what we want to see ideally is that if we were to see a reversal from here, we want to see the 4 hours or even a 1 hour starts forming your bearish market structure. Okay, so that in that case, right, then this would line up with the exit on stochastics, right, from the overbought region. So again, right, it's important because when prices are trending strongly upwards, you can see that stochastics can stay in the overbought region for prolonged periods here, right? So if to just shift back slightly, you can see that at this area, right, stochastics showed many reversal, right? So price exited the region multiple times with the cross, right, of the fast stochastics below the slower one. But what happens over here, right, if you were to take a look at what happened in price, you can see that even though stochastics exited the overbought region, right, price continues trending upwards. Of course, this is also influenced by fundamental factors, right? When this was last year, right? So when Fed has every intention to raise rates, right, to tame inflation. So in this case, you can see that it's also caused by fundamental factors, right? In fact, in this example, right, this is here, right? So this move up, right? So with Fed's intention to raise rates, it should drive dollar higher, and then in turn gold should be lower. So it'll be this region, right? So this area itself, this is also characterized by strong demand, right, for gold as a safe haven. Okay, so let me just go to the 4 hours time frame. Okay, so on the 4 hours time frame, we can see that right now, right, prices are consolidating within this range. It's moving within this area here. You can see that this is the last range, right? Price starts moving sideways. You don't have clear clear higher lows or higher highs coming into this zone. So this is the last range that we have on the 4 hours, right? And this makes sense because if prices starts consolidating on the daily time frame, right, coming into this resistance area, it starts ranging sideways, then this would be a good time for us to keep a lookout for any exit in the overbought region. The idea is that if, right, given the fractal nature of markets, if prices are to trend lower, we need to first see that bearish market move happen on the lower time frame, right? So this can be in forms of successive lower lows and lower highs, or a break of the last range, the last support level, which then shows that price failed to form new highs, and in this case, prices are respecting this resistance area. Okay, so this is the picture on the 4 hours, right? So right now you can see that prices are still moving sideways. So we either wait for a break below this region, and if I were to extend this area across, right? So let me just remove all these drawings. If you were to extend this area across, you can see that on the 4 hours time frame, it's also support level, right? It was the previous resistance. Okay, you can see that it was the previous resistance where we saw that rejection, and the price broke above it. Currently, it's testing this region again as a support. Okay, so what I'm waiting for right now, it's a break of this zone on the 4 hours for a bigger move to the downside, right? This for me is the next support level on the 4 hours. Again, just looking at the levels, right? It's an area where price interacted or we saw hesitation coming into the zone. Okay, that's one. And I think what would also confirm the move to the downside, it's if we see an exit of the region accompanied with a break of the last low here. Okay, so let's go down to the 1 hour time frame, right? So on the 1 hour time frame, you can see that currently, right, price form a new low, held, come into a resistance area here, right? But this, I would still not consider this a double top, because if we want it to qualify as a double top, we need the break of the neckline, right? So for any double top to be formed, right, we need price to break below the neckline in order for that pattern to be completed. So in this case, you can see that when price comes into this zone, right, we just have a low over here, right? On the 1 hour time frame, you can see that there's an exit of the region. But what we are not seeing here is that we're not seeing a bearish structure yet, right? So you can see on the 1 hour, this is the last low. So once price breaks below this low, pulls back, right? And in this case, if this corresponds to an exit on stochastics, then yes, right, then that would be a higher probability setup. But right now, where prices are, you can see they're still ranging, so we have to wait for that confirmation. Okay, so this is the picture for me on gold, right? Let's take a look at another example, right? And if you guys have any questions at the same time, right, do put your questions under the questions tab. Okay, so maybe instead of taking a look at another example, right, let me just move on to how we can also combine them with moving average. So for moving averages, right, the idea is that moving average basically measures the average, right, of the past number of periods that's input by the user, right? So usually you can use, usually the default will be using close price. So if prices are below the moving average, then it gives us a bearish signal. If it's above the moving average, then it gives us a bullish signal. So in this example, right, how would we use the moving average to confirm this area? Is that when price breaks below this region, right? So if price breaks below this support level here, let me just load the moving average. So moving average itself, I have a preference for exponential moving average, right? So usually I toggle in steps of 5, right? Anywhere from 20, 25, so on and so forth. So if you want it to be more sensitive, then you use a lower period, right? So let's say a 9 days exponential moving average would be more sensitive as compared to a 20 days exponential moving average. But in turn, right, because it's more sensitive, given the lower number of periods used, it can also generate a lot of false signals. So it's just something that we have to balance with, right? So in this case, you can see that if I were to load the 20 days exponential moving average, right? So there are different types of moving averages, right? So exponential just means that it gives more weight to recent price. There's also the SMA, which is a simple moving average. So for SMA itself, it gives equal weight, right, to the past X number of periods that the user defined. So in this case, you can see that for EMA, right? So EMA, it's the one in blue. I'll probably just change it into a different color so that we can distinguish it from our own markings. So let me just change this to red. Okay. So in this case, you can see that the 20 EMA, at least on a 1 hour time frame, right, might not be as ideal because it gives a lot of false signals, right? Especially in this region, right? This area here, you can see that there's a false break below before price continues to the upside. So in such case, right, you might want to either change the time frame or change the moving average. Okay, so in this case, I'll just change to a higher time frame and see if price respects this region more. So in this case, you can see that this will probably be a better indicator on the 4 hours, right? So let me just remove these drawings because they're kind of getting in the way. Okay, so this area here, right? So I'll just put back the 4 hour support because that's the region that we're waiting for that break. So still the same low here, right? And again, if I have to extend it across, you see the same area. So this is the support area, right? So if price breaks below this, right? So how I will use this moving average is that if price breaks below this area, right? This is the first sign of a bearish market structure. And this accompanied with an exit on stochastics from the overbought, right? This shows that the buying pressure is slowing, right? Or there's not enough buying pressure to sustain the upwards move. So for moving average, how we can use it is that if price breaks below this area, right, we can use the moving average as a dynamic resistance, because if price stays below the moving average, right, you can see that then we could see price continue lower. But that's only when the bearish structure comes in place. Okay, so for example here, right, so take a look at this. We have, see again, right, bearish market structure, lower lows, lower highs. Okay, and if I were to put it in close, you can see pretty much the same thing, right? So just take a look at the peak and troughs of the price movements. You can see that prices are forming successive lower lows and lower highs. And what's even more interesting with that is that the moving average, the line in red, right, this acts as a dynamic resistance. When price continues trending lower, you can see that the moving average, right, will come, or it coincides with the peak of price movement. Okay, and then when do we know whether, you know, the trend is going to change? The trend changes, right, when price breaks above the last high that broke the low. So in this case, you can see that price continues to the downside, right? So price broke structure here. And if the downtrend is to continue, again, we're expecting lower lows and lower highs. But what happens after is that you can see here, right, this move, price came into this region, it formed a new low over here. It formed a new high here. And then what happens is that this high itself did not break below this region. Price broke above this high. It also broke above the last high, which broke this low. So a pullback into this zone, right, once it breaks above, you can see that this is the first sign of a change in structure. Right, so I'm just taking it solely based on one time frame, but the idea is the same. You can apply this idea across different time frames. So once price breaks above this region, right, in a bullish structure here, once we have this first sign of a bullish structure, we want to wait for stochastics as the bullish confirmation. So the bullish confirmation, it's here, right? So it's found here where stochastics exited the oversold region. You have your fast stochastics, the blue line crossing above the orange line, that's one. And you can use the moving average as an indication. So if I were to switch back to candlesticks, you can see that price broke above the moving average. It's also characterized by a strong bullish candle, right? So this shows that there's sustained buying pressure, right? And it's not just a fake out. So when price broke above, it then retested this moving average as a dynamic support. You can see that in this case, right, the 20 EMA actually lines up very nicely with the 4-hour zone. So you can see that this, right, it's price came into this 20 days EMA as a dynamic support before it continues trending to the upside. And even then subsequent tests of this moving average, right, apart from this region where there was a fake out, but subsequent tests of this moving average, you can see that price held very nicely above the moving average. And even though, right, stochastics on the 1 hour time frame is showing an exit of the overbought region. This doesn't matter because once price transits from a bearish to bullish market structure, but we're not looking for areas to sell because we're not selling in an uptrend, right? We try and we try and trade in the direction of the trend. Selling in an uptrend will be caught in all this sharp spikes up, right? Or huge movement up with very little retracements. Okay, so I hope that this is clear so far, right, in terms of how we can use stochastics, how we can use market structures, and how we can use moving average to filter out the signals. Moving average by itself, right, as with any other indicator, right, it's best when you combine them with market structure. So market structure itself will give us a very clear direction of the trend, especially when there is that change from, let's say, a lower downtrend, right? Once price breaks above the last high, then this is the first sign of a change. Then this is when it gives us clue as to whether we want to focus on the overbought or oversold region. Okay, so this is on market structures, on stochastics, and moving average, right? So one last thing to note is that for our take profit targets, right? So there are a few ways you can actually use the take profit targets. One would be, of course, in an uptrend, right? So in a bullish market structure, we always use the last high as the target. The idea behind this is that this is the resistance area. So if price revisits this zone, right, then this is an area to consider. And especially so in an uptrend where we're expecting the highs to be constantly run. You can see the price did a slight retracement before it broke above the high, right? And then once again over here, price did a slight retracement before it broke above the high. So that's one. right? Another way you can do this, right? So I've covered this previously in the Fibonacci series. The idea is that when price comes into this zone, right? So usually the entry would be based on following the break-in structure, 78.6 retracement or 61.8 retracement. So assuming that we were to go back in time, you can see that if this is the push-up, which broke structure, you can see this move up. It broke the previous, it broke the last high, right? At this zone itself, right, this is the first sign of a change in market structure, and any pullback would then present opportunities to buy. So in this case, you can see that usually the 78.6 and 61.8 retracement, right, these two levels can be useful because you're basically buying or entering at a cheaper price, and it's better if prices are in an uptrend or there are indications that, you know, there is a trend reversal. So in this case, price dipped slightly below the 78.6 retracement. You can see here, right? And this, once price comes into this zone, right, we have the high as the first target, right? So recall for the take profit target, the high would be the first target, which is around this area here, right? You can also switch it and close and just use the resistance area and close, right? So then this gives us some buffer for our profits, right? So for the take profit target. So you can account for spreads and also, you know, when price comes into a resistance area, right, we want to get out of the position before price, or we want to take partials at least, right, when it comes into a key resistance area. Okay, so the other way we can do this, right, apart from just taking it based on just graphical high, is to use the negative 27. So I've actually series, right, negative 27.2 will be one take profit target. So it's here, right? So negative 27.2 and negative 0.618. So these are also potential targets that we can consider. And you can see that coming into this region, so price came into this area, right? And what we have following, which is that it's a slight gap, it gapped up from here and then rejected off the negative 61.8, right? And if you look to the left, you can see that with the Fibonacci retracement, right, it's also in line with a graphical area. Okay, so these are areas to consider, right? Of course, we don't want to take it purely just based on retracement levels. We want to ensure that to the left of prices, right? If this is a key zone to watch, especially if you have a significant reversal, right? Just lying slightly below your negative 27, then it'll probably be wise to take it off that level instead. Okay, so this is for profit targets, right? So I hope that it's clear so far, right? And if you guys have any questions, right, do put them under the chat. Okay, so we have covered on stochastics and market structures, right? And also how we can use moving average to filter out the signals. Okay, I also talk about setting our potential profit targets using Fibonacci retracements. If you want to find out more about Fibonacci retracements, right, we have the Fibonacci series on YouTube, so do check out that, right? And then also for risk management itself, right, setting proper stop losses and profit targets, and also ensuring that one trade doesn't blow the account. Okay, so if we have no other questions, right, I see that we have no other questions, right? So then that's all that we have for today, right? So thanks everyone. And for tomorrow, we will be having our live trading session, right? So do sign up for this link. You can actually find the schedule on vantagemarkets.com/webinars. Okay, so thanks everyone. Stay safe, trade safe, and we will catch you guys again tomorrow.